Well, today is May 9th, 2015. Welcome to North Star Oasis. I'm your host, Jeff Williams, here for another action-packed episode. Before we begin, I do want to make a note to our crack staff who we have here, as I usually try to give them kudos whenever appropriate, and to let you know that when we package our shows together, you know, it's a combined effort. We have a really great bunch of researchers on our staff, and our homework continues throughout the week to give you this, what we hope is fine programming on your local public access channel. If we can go to camera 1 real quick, this is a book, Elephant Destiny. Let me flip that down, I'll tell you that later. But Elephant Destiny, biography of an endangered species in Africa. So when we discuss with you about elephants, when we discuss policy, when we discuss history, I just finished reading Elephant Destiny actually just yesterday. So in the future, I'll be having something to say about that, more policy oriented. That's not today's show, but I read that. Sometimes Andrew, our intern, he'll throw things my way, and he'll see things, or he'll say, hey, listen, I got a great segment for you. Dallas, our producer, does a really great job in looking for things, and he calls stuff to my attention, and a lot of times we'll go to events together. He'll serve as a cameraman, and we've really got a great team that works every week on giving you this content and being able to put all this together. So as we sit here at about our 6-month mark into our tenure on the show, I just wanted to say a big thank you to our staff. And that also brings me into something that just occurred, and we're going to go back to camera 1 for this, and this is a headline in the Star Tribune last week. Actually, it's only the bottom that I need. And we have, there we go, this came out on Thursday, so just the other day. What does that look like on the front? No, not invasive species, game changer, but a railroad explosion. Now, when we started this program back in November, we highlighted the need for the Keystone XL pipeline because of railroad safety. And we heard the speech from Barbara Boxer, U.S. Senator on the floor of the U.S. Senate, highlighting how the stuff that's coming down from Canada or the Bakken is some of the most grimiest pollutants that we've known on Earth, that it shouldn't be transmitted through a pipeline, and it's just not safe. Well, this right here is exactly the reason why we argue for a pipeline, simply because we want to see stuff like this disappearing from the landscape. Now, we were bringing this up way before the Star Tribune, way before the Pioneer Press. We were bringing this up when nobody else was talking about it. Now, it's front page headlines. So now we're going to take a look right now at another thing that occurred before I get into railroad, and that is something that's going to be occurring in 88 weeks. And no, I'm not talking about what's going to be occurring in 229 days, because that's the number of shopping days left until Christmas. So we're getting down there a third of the way through the year. But in 88 weeks, we will be inaugurating a brand new president. President Obama will be at the end of his 2nd term, and so the presidential race for 2016, for 2017 president inaugural has begun. And so in 88 weeks and 5 days, we will be bringing in a new president. So we've been taking these in the order in which the candidates declare. And that is, we started off with Hillary Clinton. Last week we talked about Ted Cruz. And today we're going to show you another announcement. Let's go to the first clip.
Rescue a great country now adrift. Join me as together we seek a new vision for America. Today, I announce, with God's help, with the help of liberty lovers everywhere, that I am putting myself forward as a candidate for President of the United States of America.
Yes, folks, Libertarian Republican candidate Rand Paul, son of Ron Paul, perennial Republican slash Libertarian presidential candidate, has formally announced that he is running for president. And that is probably the second worst kept secret in Washington. I think the first worst kept secret in Washington was that Hillary Clinton was going to run in 2016. She's already made that announcement. Rand Paul has now announced. Let's take a look at some of the excerpts from his announcement speech.
The Washington machine that gobbles up our freedoms and invades every nook and cranny of our lives must be stopped. We borrow $1 million a minute. This vast accumulation of debt threatens not just our economy, but our security. We can wake up now and do the right thing. Quit spending money we don't have. Congress will never balance the budget unless you force them to do so. Congress has an abysmal record with balancing anything. Our only recourse is to force Congress to balance the budget with a constitutional amendment. The enemy is radical Islam. You can't get around it. And not only will I name the enemy, I will do whatever it takes to defend America from these haters of mankind. I say that your phone records are yours. I say the phone records of law-abiding citizens are none of their damn business. To rescue a great country now adrift, join me as together we seek a new vision for America. Today, I announce with God's help, with the help of liberty lovers everywhere, that I am putting myself forward as a candidate for President of the United States of America.
So, Senator Paul did say the words, and I'm going to quote just from a clip that we saw there, that Congress has an abysmal record in balancing anything. Now remember that quote a little bit later in the show, because we are going to be talking about a thing that Senator Paul wants Congress to take control over again, which, if Congress has an abysmal record in balancing anything, might not necessarily be the best course of action. I will agree with him on the need for a balanced budget amendment for the U.S. Constitution, because Congress cannot balance has an abysmal record in balancing anything. So this is where Senator Paul and I are in complete agreement. A balanced budget amendment will do wonders in getting our fiscal policy back in order. We also need to make sure that we have a cap on the amount of debt that we can offer. There's a lot of things on the economy that Congress should be doing, can be doing, but isn't doing. And when I say Congress, I'm saying that in a generalized statement, not specific to one party or the other, because this is a situation where I think both parties have been putting us down a pathway that has not necessarily been good for the long haul. So now, what do the comedians in Hollywood have to say about Rand Paul? And so, Senator Paul is now in the race. There have been a few other candidates who have declared since then. So we now have Hillary Clinton for Democrats. And then in order, we've had Ted Cruz, Rand Paul, Marco Rubio, Ben Carson, Dr. Ben Carson, Carly Fiorina, Mike Huckabee, and then on the Republican side, and then most recently, Senator Bernie Sanders, independent from Vermont, has also jumped in on the Democrat side. And it's expected that former Maryland Governor Martin O'Malley will probably also jump in on the Democrat side. So what we're doing is we're taking these in the order in which they declare. So when the self-avowed socialist Bernie Sanders chance to discuss him is up, then what we will do is we will talk about him accordingly. But right now, I'm giving Senator Rand Paul the moment that this is his 6 minutes of fame on North Star Oasis, which, by the way, you can catch us on Facebook, Twitter, and YouTube, and it's just simply at North Star Oasis. So we hope you join us not just here on your television set, but also online. And now that we are pretty much finished with this segment, we are going to move right back on to the railroads, because we highlighted the Star Tribune headline of the oil tanker explosion in North Dakota. And so now we're going to go over to a clip from the Fed Gazette.
The freight rail network is like a giant conveyor belt made of a series of smaller belts. A smoothly running loop delivers goods efficiently to their destinations. But if any part of the conveyor slows or stops, things go awry. Hi, I'm Phil Davies, Senior Writer for the Fed Gazette. For much of the past 2 years, the railroad conveyor in the 9th District slowed markedly, partly because of escalating demand. Farmers, electric utilities, and other shippers complained about slow trains and higher freight costs. In response, freight railroads have made robust investments in infrastructure, equipment, and people. Partly because of this spending, rail service in many parts of the district network has improved in recent months. But for a number of reasons, including a strengthening economy, matching rail supply to demand in a region remains a work in progress. Major freight railroads serving the district include BNSF, Canadian Pacific, and Union Pacific. In addition, more than 20 regional and short-line railroads transport commodities such as grain, coal, crude oil, and metal ores. Rail traffic has increased nationwide since the Great Recession, and there has been huge growth in shipments of petroleum products, including crude oil. Although crude share of rail freight is small, oil shipments have risen fast, with most of the growth occurring in the upper Midwest because of increased oil production in North Dakota and Canada. Beginning in the fall of 2013, rising freight volume combined with a big crop harvest and harsh winter weather caused widespread disruption of rail service across the region. The backups affected shippers across the economic spectrum. For farmers, rail problems meant slimmer profits. A University of Minnesota study found that in the spring of 2014, higher shipping costs due to rail delays cost Minnesota growers about $100 million. Rail congestion also delayed coal deliveries to power plants, forced iron mines to use trucks to deliver taconite pellets to lake ports, and sowed havoc for Amtrak passenger trains, which run on routes owned by freight railroads. But conditions can change rapidly in rail markets. Over the winter, freight was flowing more freely than it had last fall. As this chart shows for North Dakota rail traffic, fewer grain rail cars were delayed after the first of the year, and less congestion on the rails lowered overall freight costs across the district. One reason congestion eased was a seasonal drop in rail traffic. Another was low crop prices, which led many farmers to store their grain after the fall harvest, rather than ship it to market. But railroad investment also played a role in reducing rail delays and costs. In 2014, railroads large and small spent well over $1 billion to expand capacity in district states. Work included laying new track, upgrading technology, and hiring more train engineers and rail yard workers. The wild card in any forecast of rail conditions is the outlook for crude oil production in the Bakken and in Western Canada. A sharp drop in oil prices this last summer will likely curtail oil shipments, freeing up capacity for other commodities. But it's not clear when this will happen and how much crude by rail traffic will fall. For much more on rail congestion and capacity expansion in the district, see the April issue of the Fed Gazette. Thanks for watching.
And that was from the April 2015 Fed Gazette. That was just last month, a couple of weeks ago. And yet, all of these issues that he had mentioned in this one short clip has been just about everything that we've been discussing on this show. So if you've been a veteran viewer of our program, we thank you for continuing to watch us. And I'll bet you could just nod your head when you're watching that clip and say, I knew that. because you've been watching North Star Oasis, and we've been telling you this all the way since November, that there are problems, and the problems are we don't have the pipeline. And here's the thing, if we have the pipeline, we can have better rail safety, we can lower the capacity, the capacity for, we can increase the capacity of non-petroleum shipments. We have safer railways. We can get our grain to market. I mean, he mentioned that because of crop prices and transportation prices, the farmers spoil grain instead of shipping to market. Now, does that make any economic or logical sense to you? That you would actually take the time to grow something, but then you can't profit from it because it's just sitting there spoiling. Now, if these farms that are doing that happen to have large cattle herds and the crop spoilage can be used to feed the cattle, that might not necessarily be a bad thing. But in farm economy, most of this is counted out very, very carefully, and most of the spoilage is just that, spoilage. It doesn't benefit anybody. So then why even plant it? Well, you still, if you're a farmer, you make money. I mean, the whole farm economy is just a whole different way of running things. And, you know, farmers, they run on a very razor-thin margin. And if you go back to the 1980s when we had the rural Minnesota farm crisis, a lot of that came from having to borrow until borrow to plant, and then you pay back the loan when you bring your stuff to market. But then if you're not getting as much for your crops as you can pay the loan, then you're upside down. That's the way the farm economy runs. And so the railroads really play a very big factor in that. And so to take trains that were making grain shipments and iron ore shipments and coal shipments and then converting them mainly to oil shipments, when there's another way of transporting the oil, that has that domino effect. And that's what the Fed Gazette piece had just shown. But again, it's the stuff that we've been discussing for the last 6 months. So now, what happened last week? As we had shown you on the front page of Thursday Star Tribune, there was another oil train explosion. And let's show some video on that.
Next to a massive oil tanker train derailing, erupting into flames, forcing evacuations tonight. The thick, dark smoke from the fire seen for miles, hazmat crews rushing to the scene. And with U.S. oil production now booming, there is growing fears that this could happen far more often. ABC's Clayton Sandell tonight.
Huge plumes of smoke and fire erupting into the sky. The train, over 100 cars long, loaded with crude oil, derailing, then catching fire this morning. 6 cars engulfed. So much smoke, residents in the tiny town of Heimdall had to be evacuated, but no one was injured. It's the 8th oil train derailment just this year. A few months ago in West Virginia, another train carrying crude oil jumped the tracks, sparking this huge fireball. Hundreds of families evacuating.
I've never seen anything like this in my life.
Every day in the U.S., over 1 million barrels of crude oil travel by train, often on tracks that critics say are aging and in need of an upgrade.
These are, in many times, going very near our homes, our schools, and our businesses.
Just last week, American and Canadian regulators issued tough new rules for these oil cars, including lower speed limits and requiring stronger tanks and better brakes. But David, critics say it will be years before all tanker cars are up to those new.
Well, there we have it. Tough new rules. Change the speed limits. Let's throw more money at the infrastructure. Now, I'm not going to disagree with the more money about the infrastructure, but as the Fed Gazette piece had shown, that railroads are already investing in improving their infrastructure because they're the ones who own that infrastructure. And so what do we have? We're having Band-Aid fixes. We're having Band-Aid fixes by Mark Dayton. We're having Band-Aid fixes by Paul Marquardt from the legislature. You know, we're wanting to spend taxpayer money from the state on stuff that the railroads can and will do themselves. And it all is because there's a problem and politicians feel the need to do something about it. But what they really need to do is reverse the bad policy, because that's what this is all based on. It's based upon Warren Buffett owning a railroad through Berkshire Hathaway and preventing the legislation to pass through his friends in Congress that would increase the pipeline capacity, which, again, as we just mentioned, can be safer. It can reduce transportation costs, and it can prevent that domino effect of a backlog on other things that need to be shipped by rail. So again, this is all based on policy, and bad policy at that. And that's what really needs to change. Not reducing speed limits, not throwing in state money to fix railroad crossings because oil trains are parked in the way and can't, you know, and when they stop, they prevent grade crossings. You know, that's all of the Band-Aid fixes. But let's get to the heart of the matter. Heart of the matter is Congress needs to pass Keystone XL. The president needs to sign it. It's really as simple as that. Now, yes, once that does happen, whether it be now or whether it happens 88 weeks from now, I recognize the fact that it will take a few years in order to get the pipeline built. But you got to start somewhere. Just like the whole debate about drilling in Anwar that happened during the Bill Clinton administration. And we were told, oh, well, nothing will come of this for 10 years, even if we were to pass it. Well, it's now been 20 years, and there's still no Anwar. And all it's going to be is just one more excuse after another. And yes, there are going to be those who claim that Keystone XL will not carry domestic production, and that may be true to a certain extent. However, you know, when you're in a globalized economy, world economy, then that is just going to be able to stem the tide from other areas, which I'm not going to really do the whole discussion today about the petroleum economy throughout the world, other than to say that a lot of these oil trains coming across Minnesota from the Bakken Reserve and from Canada, they are going right now into the East Coast. And that was a story that came out last week where the foreign imports of oil into our ports on the eastern seaboard to the refineries there have been cut pretty much in half, and that's been supplemented from the domestic production in North Dakota, which means more oil trains passing through Minnesota, putting our citizens at risk when we could at least alleviate some of that through a pipeline and possibly create another pipeline to go to the East Coast if necessary. But there are other ways of handling things. But right now, what are we seeing? We're seeing the results of a decade or longer of bad policy. So let's take a look at what Warren Buffett actually has to say about rail safety.
BNSF Railway, owned by Warren Buffett's Berkshire Hathaway, has had another train derailment. A small town in northern North Dakota was evacuated after the train left the tracks and several tanker cars caught fire. Just last weekend, Buffett told me Berkshire planned to spend more on improving rail safety this year.
BNSF was a very strong performer in your earnings report. Any concerns about profitability being squeezed by the new rail safety rules?
Well, I'm sure it'll have an effect, but over time the railroad is going to do fine. But there's nothing wrong with spending money on safety, and I haven't read the 300 pages of rules, but undoubtedly there will be things in there that will cost us more money, and if it makes the railroad safer, you know, God bless it.
BNSF put out a statement on the derailment saying there were no injuries and the company was working with local fire departments. BNSF was also involved in an explosive train collision in Castleton, North Dakota in December 2013. Just last week, the National Transportation Safety Board said a more stringent inspection of some equipment may have prevented that accident. I'm Rhonda Schaffler for The Street.
And the derailment accidents that we've been highlighting lately have been on the new tanker cars. These are supposed to be safer. As a matter of fact, they were also built by another subsidiary that Warren Buffett owns. So if he wants to spend more money on rail safety, I sure hope he opens up the spigot in our state. I hope that he takes it upon himself to, build some new crossings in New Hope and Coon Rapids and in that area. I really hope he takes it under advisement to replace all of the BNSF rail structure that's here in our state, because this is kind of like we're ground zero for the BNSF pipeline, because it comes from the Dakotas, and where does it go to get to these refineries? It comes through Minnesota. The oil comes through our state, and then it'll either go to the refineries in Houston or it'll go over to the East Coast refineries. But it just seems that we're ground zero for the BNSF and Canadian Pacific oil cars. We're it. And yet, every time we have a derailment, it's with a new safety car, and we get the statement that no injuries have been reported. We have been working with local fire departments. But I really don't want to see the day when this is a catastrophe waiting to happen, that's just waiting to happen. I don't want to see it happen. I don't want to see us continue to ignore this and then wake up one day and we find out that, oh yeah, I'm sorry, but the east side of the city of St. Paul from around Maryland, Maryland Avenue is just gone. I'm sorry. We just killed 10,000 people because we didn't take care of this sooner. I don't want to see the long-term health risks that come from people breathing the petroleum fumes that come out of the rail incidents. And that's one of the reasons why we keep bringing this up to you, every couple of weeks on North Star Oasis. It's because the risks are high and the risks are real. And if we're seeing all this stuff around, we want to be the ones to send a clarion call into our own community, our own neighborhood, to say, hey, folks, wake up. This is what's happening. And it's happening right here in a community near you. And we just don't want to see anything catastrophic happen when we know full well that this is a result of bad policy, the result of one billionaire who wants more. And I've always maintained that I'm not opposed to the profit motive of Warren Buffett and Berkshire Hathaway. Not opposed to that at all. But when it comes to his profits over the health of our citizens, that's where I think we draw the line. So anyhow, we are going to move on from rail. I know some of you who watch this every week and you say, oh, another rail show. Oh, thank heavens you're moving on from rail. So, thank you for putting up with that. But last week, if we can go back to camera 1, our producer, Dallas Pearson, and I have no idea. Okay, oh, that'll work. Ron Feldman, Federal Reserve Bank of Minneapolis. There is a presentation that the Federal Reserve Bank of Minneapolis has called Conversations with the Fed. And so Dallas Pearson, our producer, and I, we were at the one on Thursday, and they were also kind enough to give us some money as we walked out. Of course, it's not spendable in this form, but this is the shredded currency bags that they give you. When the Fed takes money out of circulation, usually the stuff that's all crumpled and nobody wants anyway, then that's what they do, is they'll shred it and then they'll give you souvenir bags. But we were at the Fed, and I know the libertarians who are watching are saying, oh, facepalm, why is he at the Fed? And the simple reason is we feel that we need to understand the Fed a little bit more. And it's one thing to hear the libertarian perspective that the Fed is bad, the Fed is evil, we need to end the Fed or ban the Fed, but it's also important to take a counterbalance to that to make sure that we can go back to, okay, hold on one second here, folks. To our young producer, intern, thank you for bringing us back on the right camera. Anyhow, we were at Conversations with the Fed. We feel that it is important to see both sides of the story. Let's understand. This comes back to what I mentioned earlier about our crack research staff, that we want to dig deep. We want to understand these issues. We want to see. The libertarians say the Fed is bad. Let's see what the Fed has to say. Let's look back through history. Let's look at the causes and consequences of actions. Let's understand what the real issues are, and then we'll spend a half an hour on occasion to discuss them with viewers, because we feel that we don't want to just give you the smoke and mirrors of political arguments. We want to really dig deep and give you what we believe is more of a factual, truthful statement when it comes to policies. So we were at the Fed. We had a good tour of the Federal Reserve Bank. We had a really good meeting with Ron Feldman, who is the author of the book Too Big to Fail. And so when we begin this segment today, we're going to ask, well, what is the Fed? That's like that thing we keep hearing about in Washington. Why does it have to be, and why are the libertarians saying it has to be ended? What's the good of it? What does it do? And that's what we're going to start here today in explaining. So right now, let's go to our first clip, Federal Reserve Explained.
Are you fed up not understanding the Fed? What exactly is it? And what do they do?
The Federal Reserve must be alert to
parenthetically that the downward revision of the fourth quarter GDP number.
Quantitative easing, we've been buying longer-term Treasury securities.
Okay, let's try that again, this time in English. The Fed, short for the Federal Reserve, is the gatekeeper of the U.S. economy. It was established back in 1913 by President Woodrow Wilson. That's because 6 years earlier, a bunch of banks went bankrupt and caused widespread panic. It was kind of like this.
Hey, lady, you got any money in the bank? You better hurry. Uh-oh.
So Congress figured somebody better be in charge. The Fed became the nation's central bank, overseeing the entire banking system for the country, figuring out how much to loan those banks at what interest rate, and making sure they're a safe place for people to keep their money. But the Fed has an even bigger role, to ensure the U.S. economy stays strong by closely monitoring it. They do that by dividing the nation up into 12 regional economies. They keep tabs on what's happening in those economies, and they get together 8 times a year to report back. Who are they? The FOMC, or the Federal Open Market Committee. That's a group of 12 people led by the first woman chair of the Federal Reserve, Janet Yellen. And like E.F. Hutton, when the Fed talks, people listen.
And E.F. Hutton says,
economists, as well as the stock market, follow every report carefully, wondering if interest rates are going to go up. Because when they do, it has a ripple effect on the whole economy. It's more expensive to take out a loan, and people are left with less money to spend. Interest rates go up as a way to pump the brakes on a good economy to ensure it doesn't get too hot, meaning too much inflation. When the economy needs a kickstart, the Fed lowers interest rates, which boosts borrowing and spending. So the question everyone is asking right now is, will she or won't she? The dollar is strong, inflation is low, and unemployment is down. So does that mean the economy is strong enough to handle higher interest rates? Janet Yellen has been dropping hints she might do that for the first time in 6 years.
An increase in the target range could be warranted at subsequent meetings.
But she doesn't have to ask anyone for permission. The Fed is independent. Some argue that the Federal Reserve needs more oversight.
Fed operates largely in secret. They also have too much power.
Others say Janet Yellen and the Fed already have to explain their decisions whenever Congress asks them to testify. Whatever happens this year, it will be a heavily calculated decision. So whether you're preparing to make a big purchase or just trying to figure out where the economy is heading, at least when it comes to the Federal Reserve, you can say, "Now I get it."
Okay, so now do you really get that? Now I get it. That was kind of the tip of the iceberg. There's a little bit more than just that. We will be getting into a brief bit about fiscal and monetary policy in a little bit, because that's really an important part of this. But right now there's another thing about what the Federal Reserve Bank is, and really its history and how it got here.
And just as you go to the bank to make a deposit or cash the check you got for your birthday, banks from all over Missouri, Mississippi, Indiana, Illinois, Kentucky, Tennessee, and Arkansas come to us to take care of their banking needs.
Your parents manage your family's money. The Federal Reserve manages the nation's money. But before the Federal Reserve System was established, things in America were different. The United States was facing severe financial problems. At the turn of the century, most banks were issuing their own currency, called banknotes. The trouble was, currency that was good in one state was sometimes worthless in another. People began to lose confidence in their money, since it was only as sound as the bank that issued it. Fearful that their bank might go out of business, they rushed to exchange their banknotes for gold or silver. By attempting to do so, they created the Panic of 1907. This threw the banking system into turmoil. As a result, Congress decided that the management of our nation's money and banking system should be under federal control. In 1913, President Woodrow Wilson signed the Federal Reserve Act. This act created a central bank and a board of governors to control it. A system of 12 district banks located throughout the U.S. was established to regulate the banking system and manage the nation's money. Here in the Midwest, the 8th Federal Reserve District has branches in Louisville, Kentucky, Little Rock, Arkansas, and Memphis, Tennessee, as well as a head office in St. Louis, Missouri.
The Federal Reserve is an important part of our economic system. And as important as this system is to our country, it's surprising how little we all know about it. People pass this building in downtown St. Louis every day and have no idea how important the jobs and services are that are performed inside.
Like any bank, the Federal Reserve has cash, and lots of it. In fact, all the new currency the U.S. Treasury prints is distributed by one of the 12 Federal Reserve banks.
So that was a video that was from 1989 from the 8th Federal Reserve District in St. Louis. We happen to be living in the 9th Federal Reserve District with that office in Minneapolis. So if you hear them talk about St. Louis and all of this in the Midwest and it doesn't apply to me, well, that's just because it's the difference in the Federal Reserve districts, but the concepts remain the same. Now, if you go back to the founding of our country, 1791, we had the establishment of the first Bank of the United States. I think it was First National Bank of the United States. And that was what Alexander Hamilton, our first U.S. Treasury Secretary, was really pushing. And a lot of that is when it comes to the issuance of debt, of bills, bonds, and notes, from the U.S. Treasury Department, there has to be an entity to get them into the marketplace. And that was the job of the First National Bank of the United States. That charter expired after 20 years, and then there was another bank that was created called the Second Bank of the United States. That one expired in 1836, after its 20-year charter had expired. And this is when President Andrew Jackson, who really felt he got ripped off by banks back when he was a little bit younger and before he became president, that was really what led to his animosity against the banking system. And honestly, I really can't blame Andrew Jackson for despising the banks, especially back in those days when banks really were truly independent, when they made all of the decisions. That's how things were back in the 1820s, 18-teens. But then when the charter of the Second Bank of the United States had really expired, Andrew Jackson was president, and he did not want another central bank. And that was when we had just paid off the national debt. I mean, literally, it's considered inconsequential. And just a reminder that there was no consumer protection at all back then, so we didn't have any laws on the books. We didn't have any statutes to say that banks really cannot do this, they cannot do that. I mean, it was a lot looser back then, and as a result, things like that were commonplace. I think now we may have a lot, and we might have a little bit too much. So again, it's finding balance. But with Andrew Jackson, we had already gone through the course of action for the payment of the national debt. The debt was still to this day, there's an asterisk for 1835 and 1836, and it's considered negligible. And then he passed the Species Circular, which demanded that payments to the federal land offices be made in gold or silver coin, so-called specie payment. And that took out the greenbacks out of circulation. That put us back into panic. That was the first recession that we had faced since the national debt was paid off and the charter of the Second National Bank of the United States had been paid off, had expired. And so from there, we had a series of panics that lasted all the way to the 1907 panic. You know, so we had 70 years of bank crises. They would go up, they'd come down, and go up and come down. That's the way the economy was, very compressed schedule. There was no one entity controlling our monetary policy in this country. What ended up happening was one banker, one big banker, and he still had, the company he founded, his name is still around even 102 years after he died, and that was J.P. Morgan. J.P. Morgan himself had loaned the federal government money to get us out of crisis. J.P. Morgan has also was the one to take the bonds and get them into the hands of consumers and all of that. And so when J.P. Morgan was at the end of his life and after the 1907 bank panic, that was when the Federal Reserve Act was created, really to make the central bank the bank of last resort, that when all hope is gone, you've got the Fed. That's the way it was really intended back in 1913. So what's happened over the last 102 years has been more of a change in philosophy, whereas now it seems that the Fed is the banker of first resort, and that's not the way it should be. And then there's this whole thing about monetary policy and fiscal policy. And so let's take a look at a quick explanation about that.
Paddy Hirsch at Marketplace, and today I want to talk about the difference between fiscal policy and monetary policy. Seems to be a bit of confusion here. People conflate the two. People also conflate the roles of the Treasury and the Fed and Congress. So let's see if we can sort this out. Straight explainer, no analogies, just the facts, ma'am. Okay, so first we have fiscal policy. Okay, and fiscal policy is what the government does, okay, to work on the economy. And essentially it's got three main tools that it can use: taxes, spending, and then if it has any shortfall there, debt, which is of course the issue of government debt. And the agent of the government's fiscal policy is of course our good friend Tim Geithner. There he is, Mr. G. Okay, he is of course the Secretary of the Treasury. All right, so that's fiscal policy. All right, that is the use of taxes, spending, and debt to control or influence the state of the economy. So what's monetary policy? Okay, monetary policy is also used by the government, but it is used by a certain branch of the government, which isn't really a branch of the government. A little bit confusing. What I'm talking about is, of course, the Federal Reserve, otherwise known as the Fed, headed by our big man, of course, our good friend, Uncle Ben Bernanke. He is with his beard. Okay, Mr. B, the chairman of the Fed. All right. So here's the thing about the Fed, all right? The chairman and the 12 governors of the Federal Reserve are appointed by Congress. And the Federal Reserve itself, okay, is overseen by Congress. But the Federal Reserve is much more independent. It's not a branch of government like the Treasury is. It's very independent. It could use all of the tools that it has as it likes. And all it has to do is just check in with Congress every now and again. And you've seen Ben Bernanke sitting on the Hill talking to them. So what has the Fed got in its toolbox to influence the economy in so-called monetary policy? It's got a number of things. I'm just going to run through them. The first thing is interest rates. Okay, we have all heard about those things. You know, if they have a target rate, they want banks to lend at a certain rate. That can influence how much money goes in and out of the banks. The next thing is the money supply, also called which is influenced by what's called open market operations. Okay, so open market operations. And what that is, that's when the Fed goes out and it buys debt buys treasuries from the banks. The more treasuries that it buys, the more money that goes into the banks, and then the banks will presumably lend. The next thing is the use of the discount window. Okay, the discount window is where the banks go to borrow from the Federal Reserve. And depending on what the rate is at the discount window, the banks will be able to borrow more or less, you know, and again, hopefully be able to lend out more or lend out less, depending on where the rate is. The next thing is the currency peg, which they could use, which doesn't happen often. That's when the the Fed might just say, oh, we're going to peg our currency to another currency. I mean, that's kind of like way out there. But it is true that other countries do occasionally use currency pegs. And in fact, Switzerland was considering doing it. It was like on the agenda of consideration whenever they were worried about protecting the Swiss franc. Although, you know, that obviously didn't happen. The next thing is reserve requirements. Okay. So reserve requirements, that's when the Fed requires the banks to park a certain amount of money at the Fed. So it gets a bunch of their assets, a bunch of their cash, their treasury bonds, and they park them at the Fed. And what that does is it forces them, you know, to put a certain extra amount of money aside, and then it means they can't lend that money out. So that's another way of slowing down the economy. Or if they cut the reserve requirement, it would mean more money going in, the banks had more money to lend, so more money going out into the economy. So that's another way that the Fed can influence those, can influence the banks to get money into the system. So those are the usual ways that the Fed would use monetary policy. And then there are the unusual ways. The first unusual way is quantitative easing, so-called QE. We've done a whiteboard on this before. This is whenever interest rates are at zero, which they are now. And that's when the Fed will buy pretty much anything, vast amounts of treasury bonds in order to get money into the system in an emergency situation, which is, of course, where we are right now. And that's, a lot of people call this printing money, because essentially all the Fed has to do is buy treasury bonds and then just credit the account of the banks. It's essentially making money out of thin air. Just one thing about printing money, by the way. The Fed prints money actually through monetary policy, but the actual people who print money, the mint, is actually controlled by the Treasury. So that's a kind of a weird thing that people get mixed up. Anyway, the final unconventional method of monetary policy is called signaling. Okay, and that is when the Federal Reserve signals that rates are going to be a certain level for a certain period of time. And we've heard that this has happened recently when the Fed said it's going to remain, or it's going to keep interest rates at zero for the next couple of years. And that signaling allows banks then to say, okay, we're going to be safe for now, we can lend money into the system. So of course what we have now is the Fed has exhausted all of the options that it has pretty much in monetary policy. Okay, so much so that it's into these unconventional methods, which means it's now passed the buck right back to the government again, and we're into the realm of fiscal policy in order to influence the economy. Of course, this is a big problem, because it means that politicians have to get together, whereas the Fed can pretty much do what it wants anytime it wants. But whenever we have fiscal policy, it's politicians have to decide what to do in order to give Mr. Geithner, the Treasury Secretary, the power to act, which means they have to agree on how much to tax, how much to spend, and how much to borrow. And they can't, which is what's leaving all of us at the end of pretty much every day very badly needing a drink.
Go back.
I was 4 years old, so since then Jack Lew, who was the former White House Chief of Staff, he took over as the 76th Secretary of the Treasury on February 27, 2013. And then, as we've seen in some previous videos, that Janet Yellen is now the head of the Federal Reserve, replacing Ben Bernanke. But see, here, instead of having the bank runs that they had in the film It's a Wonderful Life, which was on the Katie Couric segment that we'd shown, now, instead of that run on the local bank, the banks can borrow, banks who are members of the Federal Reserve can borrow at a discount rate from the Fed window to cover short-term liquidity problems. There is no more the 1800s style of bank runs. But, on the other hand, that doesn't mean that other problems can't occur. One of the problems that we have now is, of course, with the relationship between the Federal Reserve and the U.S. Treasury and the decoupling of that. And that's where we really get into some murky waters here, is that relationship between the banks and the federal government. Even though there's independence, how independent really are they? And then, on the other hand, you have the dual mandate through the Fed, where they have to regulate banks, but then they also control monetary policy. And again, that's another area that's murky. And so when I say there's murkiness, I think that is what Rand Paul and the libertarians are kind of looking at, is where maybe there should be some finer separations. Rand Paul did mention in one of the video clips that the Fed operates in secret and it's too powerful. But on the other hand, what's the alternative? To go back to to take the monetary policy out of the hands of the Federal Reserve and put it back into Congress and really put it under the guise of having Congress also control fiscal and monetary policy. But this is still the same Congress that Senator Paul claims has an abysmal record of balancing anything. So how is it that the Congress, which has already messed up the fiscal policy, is now going to be in control of the monetary policy? And remember, the Keystone XL pipeline and the BNSF railroad, see, there is a tie here, that a lot of that is based upon bad policy. So if we give monetary policy to the Congress, instead of this separation, real or perceived, then we're going to have even worse problems. So what is the answer? And honestly, I don't have an answer to that yet. There are problems, of course, with dual mandates, and we see this with the FAA and the Transportation Department. The Federal Aviation Administration is an advocate for airlines, and they're also the regulator of airlines, and that that has a definitive effect on what goes on. But what I am going to show you now, since we're going to be running out of time at the end of the clip, we're going to skip the Kansas City Federal Reserve section, but we are going to go on to Ron Feldman and his discussion about Minnesota banking conditions. This is from the Federal Reserve YouTube channel, but Ron Feldman is the person that we had this conversations with the Fed on Thursday. And so I wanted to at least give you a chance to listen to Mr. Feldman and hear just a little bit about policy.
So what are we thinking about for next year? What am I thinking about for next year? I think we're going to have another good year. And I think it's going to depend, we're going to see the biggest gains basically where we're currently weak and the lowest gains where we're currently strong. So one way to think about it is that we're moving to something that looks like normal, looks like historical norms. So what does that mean? So that means generally we're going to expect to see medium gains for profits. Why? Because economic conditions in some of the states are improving. Because historically we've seen that bank data tends to return to its historical norms. And since these profits are a little bit lower than historical norms, my expectation is that they're going to go a little bit higher. I already mentioned loan growth. Well, with loan growth comes some profits. In terms of loan growth and problem loans, there I'm expecting them to be flat, but they're already at very strong levels. So flat at a good level is a good thing. Now, that doesn't mean that there's not some factors that could make it less than a stellar year. We know that our district is very dependent on agricultural, and there's many banks that make loans to ag producers. That's a weak sector. We also know that in some parts of the district, energy is very important. That's going to be a little bit weaker. In terms of profits, we know that some banks have improved profits basically by putting less money aside for, which is consistent with their strong levels of problem loans. But nonetheless, that was a prior source of profits. That won't be a source of profits in the future. So there are some things that are sort of hedging against a good year. But overall, I'm thinking that at least through 2015, those headwinds are not going to be so strong. So now I'm going to show you and I should just take a step back. All forecasts are going to have a lot of uncertainty to them, right? So we'll see a year from now how this turns out, but that's the forecast for now. So let me show you some data that's consistent with the points that I've just made. So first I'm going to talk about profitability. And let me explain what you're looking at when you're looking at this graph of Minnesota bank profitability. The blue line that's moving up and down with the dots is showing you actual levels of profitability for the median bank in Minnesota, so that's the middle bank. The blue line that's dashed, that's going across on a horizontal, that's the median over the longer term. So from 2001 to currently, that's what the median amount is. The red bar with the sort of barbell, that was my forecast last year. So you can see that the actual value at the end of last year is at the lower end of that forecast, which is what I've said before. And then the green bars are my forecast for next year. So I'm saying that profitability is going to be coming between that range. And you can see that their green bar is a little bit higher. The barbell is a little higher than the red barbell, which is telling you that I'm expecting things to go up. And if you think about the medium of the green barbell as being my best guess of where things are going to end up, you can see it's actually right at or above the historical norm. So this captures really all the points I've been trying to make. Profitability came at the lower range. There was some movement in profitability in Minnesota, but not a ton, and I'm expecting a better improvement next year. So let's look at another example of profitability. That's going to be Montana. Here you can see that there actually was pretty good gains in profitability. Still below the historical norm, but you can see a big gain, and I'm expecting another good year for Montana profitability next year. Again, as it returns closer to its historic norm. Now let's look at an example of loan growth. Here I noted that loan growth was generally very strong across the district and that I'm expecting a little less of improvement. You can see here for western Wisconsin that actually loan growth was better than what I was forecasting, and that I'm forecasting really that it's going to stay roughly the same. So how do you see that? Well, if you look at the last actual observation, the last blue dot, you can see it's right at the middle of the green barbell. How about problem loans? Here's an example from the Upper Peninsula. I noted that, that these are below the historic norm, so you can see that. In this case, quite below the historic norm. You can see that its actual was better than what I forecasted. And you can see I'm forecasting, again, it to stay relatively the same, as the middle of the green barbell is very similar to the last observation. Now let me try to summarize with a few.
And one of the things when, if you go back a couple of episodes ago, we discussed the Community Reinvestment Act during our Hillary Clinton segment. We brought it up with Mr. Feldman about the Community Reinvestment Act. And one thing he mentions is that they have regular meetings with people in the community to try to comply with CRA. Unfortunately, we don't know who those people are. And then he said there are plenty of ways that are safe and sound for banks to serve their communities, which to me sounds like it's a politically correct answer. I don't want to give you too much, but I have to say something. And I get that, because when you're dealing with the federal government or anything that has any sort of power in this country like the Fed, you have to be careful on how you speak. And I still think that Mr. Feldman missed what we were trying to get at, was that, with the, okay, I just got a note from my producer. You can bring back the Wisconsin chart. Yeah, if you can bring back the Wisconsin chart, since we have about a minute left. Let's talk about that, because Community Reinvestment Act, I know I could talk on for about 5 or 10 minutes, and we don't have that much time left. So I'm just waiting for the Wisconsin chart. If you take a look at western Wisconsin loan growth, actual to forecast. So first of all, I have to, notice here that they have forecasts. So Fed does forecasting all over the place. But this is the rate at which people are borrowing. The money is getting back in the economy in Wisconsin. And take a look at where it bottoms out. What does that tell you? That in Wisconsin is right after the recall election. And look at how much they've grown once they knew that in the state of Wisconsin they've got a governor who is going to be a little bit stable there. But that's our show for today, so thanks for watching. Have a great week.